The most dangerous place in the global economy right now isn't a trading desk in New York. It isn't a central bank meeting in Zurich. And it certainly isn't a Bitcoin mine in Texas. It is right here, 909 Chestnut Street, St. Louis, Missouri. Picture a monument to American corporate power. 44 stories of steel, glass, and granite. 1.4 million square feet of prime commercial space. It is a city within a city. A titan. In 2006, this building was the crown jewel of the Midwest. Investors fought for the privilege of owning it, and when the gavel fell, it sold for a staggering $205 million. Fast forward to April 2024. The tenants are gone, the lights are out, the building is back on the auction block. But this time, the bidding didn't start in the millions. It started at zero. When the dust settled, this $200 million asset sold for $3.6 million. Do the math. That is a 98.2% loss. To put that in perspective, you could buy this entire skyscraper today for the price of a single luxury condo in Manhattan. You could buy it for less than the cost of the raw steel used to build its frame. In fact, at roughly $2.50 per square foot, the carpet inside the lobby is worth more than the building itself.
Now, you might be sitting there thinking, who cares? It's just one empty building in a dying city. It's an anomaly.
You would be wrong. This isn't an anomaly. It is a crime scene. And the victim is your pension fund. In our last briefing, video 1.1, we exposed the liability side of the balance sheet. We showed you the $100 trillion debt bomb that governments have strapped to the global economy. We showed you the interest singularity. But a balance sheet has two sides. If the liability is the debt, the asset is the collateral, the real estate, the physical world that backs the paper promises. What happens when the debt is unpayable and the collateral goes to zero? Welcome to video 1.2. This is the story of the empty tower crisis. Over the next hour, we are going to perform a forensic autopsy on the commercial real estate market. We are not going to talk about trends or soft landings. We are going to look at the hard data that Wall Street is terrified to show you. We are going to expose the extend and pretend accounting fraud that is keeping the banking system alive. We are going to open the books on the 278 banks that are technically insolvent right now, and we will show you how this invisible crash in real estate is about to trigger a visible collapse in your city's budget. But before we get to the fraud, we have to understand the physics of the crash. We have to understand the wall. The year 2025 is not just another year on the calendar. In the world of commercial debt, it is a mathematical event horizon. To understand why, you have to understand how a skyscraper is bought. When you buy a house, you get a 30-year fixed mortgage. You lock in your rate. You are safe. But when a private equity firm buys a tower, they don't get a 30-year loan. They get a 5-year loan or a 10-year loan. They serve interest only. They never pay down the principal. Why? Because the plan was never to pay it off. The plan was to refinance, to roll the debt over, to kick the can down the road forever. And for 15 years, that worked. Money was free. Interest rates were zero. You could borrow $1 billion at 3%, buy a building, and look like a genius. But the era of free money is over. Today, we are staring at what the industry calls the maturity wall. According to the latest data, approximately $957 billion of commercial real estate loans are maturing in 2025 alone. Nearly $1 trillion. And if you zoom out to include 2026, the number swells to over $1.5 trillion. This is not a risk. This is a guarantee. These loans must be paid off, or they must be refinanced. There is no third option. But here is the trap. When these loans were written 5 years ago, interest rates were near zero. Today, rates for this kind of debt are between 7% and 9%. Imagine you have a mortgage that costs you $10,000 a month. Suddenly, the bank calls you and says, "Time's up. Your new payment is $25,000 a month."
And at the exact same moment, your boss cuts your salary by half. That is the reality for every landlord in America. The cost of the debt has doubled, but the income from the building has collapsed. Vacancy rates in the office sector have breached 20% nationally. In some cities, if you count the sublease space, the empty desks that companies are still paying for but not using, the availability rate is over 30%.
Today, the collateral securing that loan sold for $3.6 million. That loan is a total loss. It is a zero. The money is gone, vaporized. Now, the optimists, the people on CNBC telling you to buy stocks, they will tell you, St. Louis is an extreme example. It's a Rust Belt problem. New York is fine. Los Angeles is fine. They are lying to you. The rot isn't confined to the flyover states. The rot is in the foundation of the entire asset class. In Los Angeles, the Aon Center, the third tallest building in the city, sold in December 2023. It traded for $147.8 million. That sounds like a lot, until you realize it was purchased for $268.5 million just 9 years earlier. That is a 45% loss. In San Francisco, the building at 989 Market Street, the Ross Building, sold in 2025 for $44 million. The seller took a 68% loss.
In downtown Los Angeles, the One Cal Plaza Tower is currently in receivership. It was bought for $459 million. Today, valuations place it at roughly $121 million. That is a 73% decline. Do you understand what this means? We are not talking about a correction. We are not talking about a dip. We are talking about the systematic destruction of wealth on a scale that rivals 2008. But unlike 2008, you aren't seeing it on the news every night. Why? Because unlike 2008, the banks haven't admitted it yet.
Act 2, the forensic autopsy. We ended the last chapter standing in the wreckage of St. Louis, looking at a 98% wipeout of capital, a near total annihilation of value. Now the mainstream media, the CNBCs, the Bloombergs, the eternal optimists who need you to keep buying stocks, they will look you in the eye and tell you that St. Louis is an outlier. They will tell you it is a Rust Belt problem. They will say that prime real estate in global gateway cities is immune to this kind of destruction. They will tell you that in New York, London, and Tokyo, the trophy assets are safe. That is a comforting lie. It is a sedative designed to keep you calm while the building burns. But to find the truth, we have to leave the Midwest. We have to go to the center of the financial universe. We are going to Manhattan, specifically to 1740 Broadway. This isn't just a building. It is the Rosetta Stone for the 2025 crisis. Situated right near Columbus Circle, this 26-story tower is the definition of prime. It is not on the fringes. It is in the heart of the beast.
In 2014, it was acquired by Blackstone. I want you to pause on that name. Blackstone. The largest, most sophisticated real estate investor on the planet. The smart money. These are the people who, allegedly, see around corners, They don't make mistakes. They bought this tower for $605 million. To finance this purchase, they didn't just go to a local bank and ask for a mortgage. They used the CMBS market, commercial mortgage-backed securities. This is where the story gets technical, and this is where it gets terrifying. To understand why the global pension system is in danger, you have to understand the anatomy of a CMBS bond. You have to understand the machinery that turns a dirty building into a pristine financial asset. Imagine a waterfall. When the tenants pay their rent, the money flows into a series of buckets, starting at the top.
The top bucket is the AAA tranche. This is the gold standard. It gets paid first. It has the lowest yield because it has the highest safety. The rating agencies, S&P, Moody's, Fitch, they stamp this bucket AAA and tell the world it is as safe as a U.S. Treasury bond. This is what your pension fund buys. This is what your insurance company buys to back your annuity. It is supposed to be money good in any scenario short of a nuclear war. Below the AAA bucket, you have the AA, the A, the BBB, all the way down to the bottom bucket, which we call the equity. Think of it like a medieval shield wall. The equity is the front line. If the value of the building drops, the equity takes the first hit. They get wiped out to protect the guys behind them. Then the BBB takes a hit, then the A. The AAA investors are standing at the very back, behind 5 layers of armor. The theory, the mathematical model that runs Wall Street, says that the arrows should never reach the AAA tranche. For the AAA to lose money, the building's value would have to collapse by such an impossible amount, 50, 60, 70%, that the world would effectively be ending. Well, welcome to the end of the world.
At 1740 Broadway, the shield wall didn't just buckle, it evaporated. The anchor tenant, L. Brands, left the building. The revenue stopped. And in March 2022, Blackstone, the smart money, did the math. They looked at the debt service, they looked at the empty floors, and they realized the building was worth less than the debt. So they made a decision, a strategic default. This is crucial to understand. In residential real estate, if you stop paying your mortgage, the bank comes for your house, your car, and your wages. But in commercial real estate, the loans are non-recourse. That means the bank can take the building, but they cannot touch Blackstone's other assets. So Blackstone did the rational thing. They mailed the keys back to the lender and walked away. They washed their hands of the toxicity. For 2 years, the special servicer tried to sell this prime asset. They assumed they would get enough to pay back the bondholders. They assumed the Manhattan premium would save them. They waited for the market to recover. They were wrong. In mid-2024, the building was liquidated. Remember, it was bought for $605 million. It sold for $186 million. Do the math with me. That is a 69% loss on a trophy asset in the center of New York City. But here's the part that should make your blood run cold. The loss was so catastrophic that it didn't just wipe out the Blackstone equity. It didn't just wipe out the risky B pieces. It burned all the way up the waterfall and set the risk-free bucket on fire.
For the first time since the 2008 crisis, the people who were promised safety, the people holding your retirement money, took a 26% loss on their principal. Let that sink in. AAA is a lie. If a AAA bond backed by Manhattan real estate can lose 26% overnight,
then there is no such thing as a safe asset in the commercial sector. The risk models used by every bank, every insurer, and every pension fund are fundamentally broken. They are assigning zero-risk weightings to assets that are actually toxic. This is the Lehman moment for commercial real estate. When the safest asset becomes unsafe, the entire leverage machine grinds to a halt. And 1740 Broadway is not a unicorn. It is not an accident. It is just the first domino in a chain reaction that is sweeping across the entire country.
Let's move west. Let's look at the falling knives in California. Because if you think a 69% drop in New York is bad, the destruction in Los Angeles is almost absolute. The data coming out of the West Coast isn't just a correction. It is a total repricing of the built environment. Look at the Aon Center. This is a skyline-defining tower. It is the third tallest building in Los Angeles. It is not a dump. It is a trophy. In 2014, it was purchased for $268.5 million. In December 2023, it was cleared for $147.8 million. That is a 45% destruction of capital in nominal terms. If you adjust for inflation over that decade, the real loss is significantly higher. The owners didn't just lose money. They lost a decade of liquidity. But wait. It gets worse. Look at the 777 Tower. This is another trophy asset, owned by Brookfield, another giant, another smart money player just like Blackstone. Brookfield defaulted. The building hit the auction block. It sold for $120 million in 2024.
The price per square foot was roughly $117. To give you context, you cannot build a shed in Los Angeles for $117 a square foot. The replacement cost, the cost to buy the steel, the concrete, the glass, and pay the union labor to build that tower from scratch, would be over $600 a square foot. Think about what that means. The market is valuing these structures at a massive discount to the raw materials. It is valuing them as liabilities, not assets. It is saying that the cost of operating the building, the taxes, the insurance, the maintenance, is so high relative to the rent that the building is barely worth keeping upright. Moving north to San Francisco, the Ross Building at 989 Market Street sold $44 million, a 68% loss for the seller. In downtown Los Angeles, the One Cal Plaza Tower is currently in receivership. It was bought for $459 million in 2017. Today, valuations place it at roughly $121 million. That is a 73% decline. This data cluster confirms a structural repricing across every major geography. We have a matrix of destruction. St. Louis at -98%, Los Angeles at -73%, New York at -69%, San Francisco at -68%. This is not a correction. This is not a soft patch. This is a repricing of reality.
Now the experts will try to gaslight you. They will point to a building like One Vanderbilt in New York, a brand new shiny super tower that is 99% leased at record rents. They will say, see, the market is bifurcated. It is a flight to quality. The good stuff is fine. And they are technically right. This is what we call the K-shaped crisis. The top arm of the K represents the top 5% of buildings, the newest, the greenest, the best located. They are doing fine. Rents are holding. Tenants are paying up for luxury to bribe their workers back to the office. But the bottom arm of the K, that represents the other 95% of the market, the commodity office, the glass boxes built in the 1980s and 90s, the buildings that sit in your city center, boring and gray. These buildings are functionally obsolete. To make them competitive, you would need to spend millions on renovations, new HVAC, new lobbies, gyms, amenities. But here is the trap. You can't borrow the money to renovate them because the building is already underwater. No bank will lend you a dime to fix a building that is worth 50% less than the existing mortgage.
So the landlord is trapped. The building rots. The tenants leave because the building is rotting. The value goes to zero. It is a death spiral. And the narrative that we can just turn them all into apartments? That is a fantasy. You cannot easily convert a 1980s office tower into residential units. The floor plates are too big. There is no plumbing in the middle of the floor. There are no windows in the core. The cost to convert is $500 to $600 per square foot. Without massive government subsidies, the math simply does not work. These buildings are not future apartments. They are future rubble. So, why does this matter to you? You don't own a skyscraper. You don't own a CMBS bond directly. You might think this is just a problem for billionaires like Blackstone and Brookfield. You would be wrong. Because the people holding the bag are the banks. The banks are holding trillions of dollars of loans against these commodity buildings. And here is the secret that keeps the Federal Reserve Chairman awake at night. On their balance sheets, the banks are not marking these loans at the Act 2 prices we just discussed. They are not marking them at a 69% loss like 1740 Broadway. They are not marking them at a 98% loss like the AT&T Tower.
They are marking them at par. They are pretending the loan is still worth 100 cents on the dollar. They are pretending the collateral is still worth what it was in 2014. They are living in a fantasy world, sanctioned by regulators. If the banks were forced to mark to market, if they were forced to value their loan books at the price that 1740 Broadway actually sold for, the entire U.S. regional banking system would be instantly insolvent. Their equity would be wiped out. The FDIC would be out of money by lunch. So how do they get away with it? How do they stare at a 70% crash in the real world and report a profit on their quarterly earnings? They cheat. They use a specific legal mechanism designed by regulators to hide the truth from you. It has a name. It is called the Hope Note. And in the next chapter, I am going to show you exactly how the trick works.
Act 3. The mechanism of concealment. If you have been paying attention to the math we just laid out, you should be asking a very specific, very angry question. If office towers in St. Louis are down 98%, and trophy assets in Los Angeles are down 45%, why hasn't the banking system collapsed? If the collateral banking trillions of dollars in loans has evaporated, why are the banks still reporting record profits? Why aren't we seeing yellow police tape wrapped around the doors of regional lenders? The answer is not resilience. The answer is not strong fundamentals. The answer is extend and pretend. You are witnessing a coordinated campaign of financial engineering and regulatory forbearance designed to do one thing: delay the recognition of losses. The banks, the regulators, and the borrowers have entered into a suicide pact. They have agreed to suspend the rules of mathematics in the hopes that, if they wait long enough, the world will go back to 2019. It won't.
But to understand how they are getting away with it, we have to open the hood. We have to look at the engine of the fraud. It is a specific transaction structure known in the industry as the A-B note modification. But on Wall Street, the traders have a different name for it. They call it the Hope Note.
Let's walk through the mechanics of a hope note, so you can spot one in the wild. Imagine a regional bank. Let's call it First Denial Bank. First Denial holds a $100 million loan on an office building. When they wrote that loan 5 years ago, the building was appraised at $150 million. It was a safe, conservative deal. The loan-to-value LTV ratio was 66%. The bank felt secure. But today, the lease has expired. The tenant has downsized to a WeWork. The interest rates have tripled. And the new appraisal comes in. The building is now worth $60 million. Do the math. The loan is $100 million. The building is $60 million. The borrower is underwater by $40 million. In a sane world, in a capitalist world, this is game over. The borrower should default. The bank should foreclose. And the bank should immediately book a $40 million loss on its quarterly earnings.
But if First Denial Bank books that loss, it wipes out their capital buffer. Their stock price crashes. The regulators shut them down. So the bank has a gun to its head. They cannot afford to foreclose. So they call the borrower into a conference room, and they offer them a deal. They say, "We aren't going to foreclose. We are going to restructure the loan." They take that toxic $100 million loan and they split it into two separate pieces of paper. Piece number one, the A note. They size this note to exactly match the current value of the building, $60 million. They tell the borrower, "Just pay us interest on this $60 million. Forget about the rest for now. If you pay interest on the A note, we will mark this loan as performing on our books." Suddenly, the bank doesn't have a bad loan anymore. They have a $60 million good loan. But what about the other $40 million? That toxic waste doesn't just disappear. That becomes piece number two, the B note.
This is the Hope Note. The bank takes that $40 million shortfall, puts it into a B note, and says to the borrower, "Don't worry about this one. You don't have to pay interest on it. We will just tuck it away in a drawer. If the building's value miraculously recovers to $100 million in 5 years, you can pay us back then. We hope you pay us." It is a lottery ticket. It is financial fiction. But here is the magic trick. By splitting the note, the bank avoids the write-down. They keep the loan classified as current. They report to their shareholders that they have a healthy portfolio. And the borrower gets to keep the building without putting in a single dollar of new equity. This creates a zombie building. Think about the incentives here. The borrower is now just a tenant in their own property. They have no equity. They have no reason to invest money to fix the lobby or upgrade the HVAC because every dollar of value they create goes to the bank's B note, not to them. So the building rots. It slowly dies. But on the bank's balance sheet, it is alive and well. Surely this is illegal. Surely the regulators, the FDIC, the Federal Reserve, would catch this. They are the referees. The referees aren't just watching the game. They are fixing the score. This behavior isn't rogue banking. It is explicitly sanctioned government policy. I want to read you the title of a document issued in June 2023 by the FDIC, the Federal Reserve, and the Comptroller of the Currency. It sounds boring. It is designed to sound boring.
but it is a permission slip for fraud. It is called the Policy Statement on Prudent Commercial Real Estate Loan Accommodations and Workouts. Prudent accommodations. This guidance explicitly encourages banks to work constructively with borrowers. It tells examiners, the people supposed to be policing the banks, that they should not automatically classify a loan as a troubled debt restructuring, TDR, just because the maturity has been extended or payments have been deferred. It gets worse. The guidance states that a loan can be considered performing if the borrower has a reasonable plan to repay.
In the context of 2025, the word reasonable is doing a lot of heavy lifting. Is it reasonable to assume that office rents will double in 3 years? No. Is it reasonable to assume interest rates will go back to 0? No. But the examiners are looking the other way. They are allowing banks to use optimistic cash flow projections rather than current liquidation values. They are allowing the banks to mark their assets to fantasy, not market. Why? Because the alternative is systemic collapse. If the regulators forced every bank to acknowledge the reality of the Hope Note, we would have a banking crisis by tomorrow morning. So they are choosing the lie. And the scale of this lie is massive. In the third quarter of 2025 alone, loan modifications surged to $11.2 billion. And here is the key statistic. 67% of that volume was just extensions. Extend and pretend. They are pushing the maturity wall from 2025 to 2026, then to 2027. They are praying for a miracle that the bond market is not going to give them.
And it is not just the regulators who are complicit. It is the rule makers themselves. You may have heard of Basel III Endgame. These were the tough new capital rules that were supposed to force big banks to hold more money against their risky bets. It was the never again promise after 2008. But as the CRE crisis started to bite, the resolve crumbled. The implementation of Basel III has been delayed and diluted. The regulators rolled back the stringent risk weighting for commercial real estate exposures. They looked at the fragility of the system and realized that if they enforced the safety rules, the patient would die on the table. So they lowered the standards. They softened the rules. They decided that it is better to have an insolvent banking system that looks solvent than a safe banking system that admits it is broke. Now, so far we have talked about the banks, public institutions with theoretical oversight. But there is another player in this game. A player that operates in the shadows with even less transparency. The private market. As the traditional banks retreat to nurse their zombie wounds, a new narrative has emerged. You've heard it. Private credit is the savior. Private real estate funds are stable.
Entities like Blackstone's BREIT, Blackstone Real Estate Income Trust, and Starwood's SREIT. These are massive funds marketed to retail investors, doctors, dentists, lawyers, as a way to own institutional quality real estate without the volatility of the stock market. They pitch you a simple story. The stock market goes up and down. Our fund goes up and to the right. And for a while, it looked like magic. In 2022 and 2023, when public REITs, stocks you can trade on an exchange, crashed by 30%, these private funds reported positive returns. How is that possible? How can the exact same buildings be worth 30% less in the public market, but go up in value in the private market? Because in the private market, they mark their own homework. The price of a share in BREIT or SREIT isn't set by millions of buyers and sellers every second. It is set once a month, based on appraisals. And who hires the appraisers? The fund managers. It is the ultimate extend and pretend machine. But there is a glitch in the matrix.
The investors aren't stupid. They saw the public markets crashing. They saw the headlines about empty towers. And they realized an arbitrage opportunity. My shares in S-REIT say they are worth $10. The market says real estate is worth $7. I should sell my S-REIT shares at $10 and buy the public REITs at $7. So they rushed for the exits. They hit the redemption button. And that is when they hit the gate. To prevent a run on the bank, these funds have a clause. They can limit withdrawals. They can lock the doors. Both BREIT and S-REIT hit their redemption gates. They limited withdrawals to just 2% of the fund's value per month, or 5% per quarter. Imagine going to your ATM to withdraw $100, and the machine tells you, sorry, you can only have $2. Come back next month for another $2. That is not liquidity. That is a hostage situation.
As of mid-2025, Starwood's S-REIT was still grappling with $850 million in unsatisfied redemption requests. There is a line of investors miles long trying to get their money out, but they are stuck. They are forced to stay invested in a market that is slowly collapsing. And why are the gates still down? Because if the funds had to sell assets to pay everyone back, they would have to sell them at the clearing price, the Act 2 price, the 60% loss price, and that would destroy the mark-to-model fantasy instantly. So they lock the gates, they slow-walk the liquidations. They too are playing for time. Do you see the pattern? The bank splits the loan into a hope note to hide the loss. The regulator issues prudent accommodation guidance to bless the hope note. The private fund locks the redemption gate to prevent the market from discovering the true price.
It is a vertically integrated system of denial, a conspiracy of silence. But concealment is not a cure, it is just a painkiller. And eventually, the painkillers wear off. You can hide the loss on a balance sheet, you can hide it in a B-note, but you cannot hide it from the blast radius. Because while the banks are playing games with their accounting, the contagion has already jumped the fence. It has left the real estate sector and infected the global financial nervous system. You might think your money is safe because you don't own office buildings, but do you have a savings account? Do you have a pension? Do you live in a city that collects taxes? Then you are already infected. In the next chapter, I am going to show you the 278 banks that are technically insolvent right now, and I will show you how a bad loan in New York City is destroying a bank in Japan and threatening the budget of a school district in Chicago. The cover-up is ending. The contagion is beginning.
Act 4. The blast radius. So far, we have looked at the crime scene from the perspective of the landlord and the lender. We have seen the empty buildings in St. Louis. We have analyzed the extend and pretend fraud used to hide the losses. But concealment is not a cure. It is a painkiller. And eventually, the painkillers wear off. You can hide a loss on a balance sheet for a quarter. You can hide it in a hope note for a year. But you cannot hide it from the blast radius. Because while the banks are playing games with their accounting, the contagion has already jumped the fence. It has left the real estate sector and infected the global financial nervous system. You might be sitting there thinking, I don't own commercial real estate. I don't own shares in Blackstone. This is a rich person's problem. You would be wrong. If you have a bank account, if you have a pension, if you live in a developed economy, you are already infected.
Because the entities holding this toxic waste aren't just private equity firms. They are the banks that hold your deposits. They are the insurance companies that back your life policy. And they are the foreign pension funds that are supposed to pay for the retirement of millions of people in Europe and Asia. We are about to trace the infection map, and we start right here, in the United States, with a list that regulators are terrified to publish. The 278 banks. A widely cited academic study on bank fragility identified exactly 278 U.S. banks with a specific fatal condition. These institutions have massive concentrations of commercial real estate loans. To be precise, these banks have CRE portfolios that exceed 300% of their Tier 1 capital.
Let me explain what that means in plain English. Tier 1 capital is the bank's equity. It is the cushion they have to absorb losses before they go bust. If a bank has $100 in capital and they lend $300 to office buildings, they are levered 3-to-1 on that specific asset class. If the value of those office loans drops by just 33%, the bank's capital is wiped out. It is zero. And remember the data we just reviewed in Act 2. St. Louis is down 98%. San Francisco is down 68%. Los Angeles is down 45%. If you apply those Act 2 loss rates to these 278 banks, they are not just stressed. They are functionally insolvent. They are walking dead. And we don't have to guess what this looks like. We have a patient zero. Enter New York Community Bank, NYCB. For decades, NYCB was a boring, profitable lender. They specialized in New York City multifamily apartment buildings, rent-regulated stuff. Safe, reliable. But as they grew, they absorbed other banks. They crossed the $100 billion asset threshold, which subjected them to tighter regulatory scrutiny. And suddenly, the market looked inside their books.
What they found was a nightmare. NYCB was heavily exposed to rent-regulated apartments where new laws had crushed the value, and to office loans that were souring. In early 2024, the cracks appeared. The stock crashed, the dividend was slashed, the credit rating was cut to junk. They needed a lifeline. They had to raise $1 billion in emergency equity from a group led by former Treasury Secretary Steven Mnuchin just to stay afloat. They survived. Barely. But NYCB is just one bank. It is the canary in the coal mine. There are 277 more just like it, sitting in towns across America. Bank OZK, Valley National, Wafd Bank, institutions with heavy construction and CRE exposure that are watching the maturity wall with terror. If interest rates stay high, and they will, these banks cannot survive without a bailout, and a bailout of 278 banks is not a line item in the FDIC budget. But the blast radius doesn't stop at the U.S. border.
One of the most perverse features of the modern global economy is how effectively the United States exports its inflation and its financial risk. We printed trillions of dollars, and a lot of that money went hunting for yield. Where did the foreign banks go to find that yield? They came to the American office market. We exported our toxic waste, and now the bill is coming due in Frankfurt, Tokyo, and Seoul. Let's look at Germany. German banks, specifically the Landesbanks, state-backed regional banks, have a long history of making terrible decisions in American markets. They bought the subprime mortgages in 2008, and they bought the office towers in 2020. Deutsche Pfandbriefkäufe,
PBB. It sounds boring, but this bank is a critical pillar of German real estate finance. In 2024 and 2025, PBB's bonds started trading at distressed levels. Why? Because they are sitting on a mountain of U.S. office debt that is turning sour.
Cold. Or take Areal Bank, another German giant. They reported a CRE exposure of 32.4 billion euros. The German regulator, BaFin, is so worried that they are actively monitoring these banks as a primary risk to German financial stability. Think about the absurdity of this. A German pensioner's savings are at risk because a tech company in San Francisco decided to let its employees work from home. The contagion is direct. The transmission line is the bond market. But the biggest victim, the whale that got beached, is not in Europe. It is in Japan. Meet the Norinchukin Bank. You have probably never heard of them, but on Wall Street, they are legendary. They are known as the CLO whale.
Norinchukin is the central bank for Japan's agricultural cooperatives. It holds the savings of millions of Japanese farmers and fishermen. But you can't make money lending to rice farmers in a country with negative interest rates. So, for a decade, Norinchukin took those farmers' yen, converted them to dollars, and went on a shopping spree in New York. They bought CLOs, collateralized loan obligations. They bought office debt. They became one of the largest foreign holders of American credit risk. And then, the tide went out. In mid-2024, Norinchukin shocked the world. They announced they would have to liquidate $63 billion worth of foreign bonds because the losses were becoming unbearable. They projected net losses of 1.5 trillion yen, $9.5 billion, for the fiscal year ending March 2025. $9.5 billion. That is the savings of Japanese farmers, vaporized by American skyscrapers. And they are not alone. Awazora Bank, another Japanese lender, saw its stock crash after announcing massive loan loss provisions tied to U.S. offices. The president of the bank had to resign. This is the definition of systemic contagion.
But there is one more victim. One that sits between the equity and the debt. The tranche that gets wiped out right after the owner. South Korea. Korean investors, pension funds, and asset managers were aggressive buyers of something called mezzanine debt between 2017 and 2019. Mezzanine debt sits between the senior loan, the bank, and the equity, the owner. It is high risk, high reward. If the building's value drops by 20%, the equity is gone. If it drops by 30%, the mezzanine is gone. Remember our loss figures. 45% in LA, 69% in NY. The Korean mezzanine positions are total write-offs. The National Pension Service NPS of Korea is facing billions in losses on these alternative investments. They are currently choosing to stick rather than twist, extending the loans, praying for a recovery, refusing to mark the assets to zero.
They are playing the same extend and pretend game as the American banks. But math is stubborn. Eventually, the losses must be realized. So, let's step back and look at the map. We have New York Community Bank on life support in Manhattan. We have Deutsche Pfandbriefbank shaking in Frankfurt. We have Norinchukin liquidating billions in Tokyo. We have the National Pension Service hiding losses in Seoul. This is a global web of insolvency. A single default in Chicago sends a shockwave that cracks a balance sheet in Osaka. And we haven't even talked about the shadow banks. In Act 3, we mentioned the redemption gates at Bright and Srite. But the rot in the shadow banking system goes deeper than just real estate funds. It infects the private credit market, the $1.7 trillion industry that has replaced traditional banks as the lender of choice for risky companies.
These private credit funds operate in the dark. They don't have to report their mark-to-market losses like public banks. They value their own loans. But cracks are appearing. In 2025, we saw the defaults of First Brands Group, an auto parts giant, and Tricolor, a subprime auto lender. These were massive borrowers in the private credit market. When they failed, it revealed that the stable valuations in private credit were a mirage. If a major private credit fund exposed to CRE faces a liquidity crunch, if their investors demand their money back like they did at SREIT, there is no Federal Reserve discount window to bail them out. They are on their own. And because they lend to companies that traditional banks won't touch, their collapse would trigger a cascade of corporate bankruptcies across the real economy. This is the blast radius. It starts with an empty office. It moves to a regional bank. It jumps to a global pension fund. It infects the shadow banking system. And finally, it lands on you.
Because when the banks fail, the government steps in. They print money to bail them out. That causes inflation. Your grocery bill goes up to pay for their bad loans. But there is one entity that cannot print money. One entity that is legally required to balance its budget every single year. Your city. While the banks might get a bailout, your city is about to go bankrupt. The empty tower isn't just a financial asset. It is a taxpayer. And when it stops paying, the urban doom loop begins. In the final chapter, I am going to show you what happens when the tax base of a major American city evaporates. I am going to show you the Act 5 reality of Chicago and Boston. The banks are insolvent. The cities are next.
Act 5. The Reckoning. We have spent the last hour dissecting the corpse of the commercial real estate market. We have walked through the empty lobbies. We have analyzed fraudulent accounting. We have traced the contagion to banks in Tokyo, its assets to the Cayman Islands, a victim that is legally required to stay and pay the bill. You. You might believe that because you don't own a skyscraper, the empty tower is not your problem. You might think that if Blackstone or Brookfield loses $1 billion, it's just capitalism doing its job. Let them fail, you say. But you are missing the most critical connection in the modern economy, the connection between the asset and the tax base. The empty tower is not just a pile of steel and glass. To a city government, it is a cash cow. It is a taxable entity that funds the police, the fire department, the schools, and the roads. In major American cities, commercial property taxes account for a massive percentage of total revenue. So, what happens when the value of that cash cow drops by 98%? Welcome to the urban doom loop. This is not a theoretical model. It is a fiscal death spiral that is already spinning in cities like Chicago, Boston, and San Francisco. And to understand how it destroys your personal wealth, we have to look at the mechanics of the assessment appeal. Here is how the machine breaks.
Step 1. The collapse. We established in Act 2 that buildings are selling for 50%, 60%, even 90% less than they were worth 5 years ago. Facts. Step 2. The appeal. The owners of these buildings, the ones who haven't mailed back the keys yet, are not stupid. They look at their tax bill, which is based on the old high value of the property, and they sue the city. They say, "Why am I paying taxes on a $100 million building when the market says it's worth $20 million? And the courts agree with them, because they are right.
Step 3. The revenue shock. The city is forced to lower the assessed value of the commercial district. Suddenly, the tax revenue from downtown evaporates. In Chicago, the Board of Review already cut commercial values significantly in the 2024-2025 cycle. Step 4. The shift. Now the mayor has a problem. The budget has a hole in it. A massive hole. The city cannot print money like the Federal Reserve. It has to balance the books. So it has 2 choices. Choice A, cut services. Fire police officers, stop fixing potholes, close schools. This is political suicide. Choice B, raise taxes on the only people who can't leave, the homeowners. That is step 5, the transfer. The tax burden shifts from the commercial sector to the residential sector. The empty tower pays less. You pay more. Let's look at the crime scene in Chicago. The city is facing a projected budget deficit of $982 million for the fiscal year 2025. That is nearly a $1 billion hole. But the pain isn't being shared equally. Because downtown values have collapsed, the tax burden has shifted violently onto residential neighborhoods. In a single year, residential property tax bills in the southern suburbs surged by 16.7%.
Imagine opening your mail and seeing your property tax bill jump by nearly 20% overnight. You didn't get a 20% raise. Your house didn't get 20% bigger. You are paying more simply because the office tower downtown is paying less. This is a direct wealth transfer from the middle-class homeowner to the insolvent commercial landlord. You are subsidizing the crash. Now let's move to Boston. The situation there is so desperate that Mayor Michelle Wu is pushing for a radical legislative change. The city is facing a revenue shortfall estimated between $1.2 billion and $1.5 billion over the next 5 years due to declining office values. If they do nothing, residential property taxes would have to rise by 33% to fill the gap. 33%. That is a confiscatory rate. That forces grandmothers out of their homes. That forces working families to flee the city.
So the mayor is proposing a tax shift. She wants to artificially keep commercial tax rates high, even if the values have dropped. She is trying to suspend the laws of economics by decree. But businesses have legs. If you tax an empty building as if it's full, the owner will just abandon it faster. It accelerates the doom loop. And then there is San Francisco. The city projects a budget deficit exceeding $1 billion by 2027. The revenue from transfer taxes, the money the city gets when a building is sold, has collapsed because no one is buying buildings. The revenue from business taxes, which is linked to how many employees are physically in the office, has collapsed because the workers are at home. The revenue base has been hollowed out. This leads to the final stage of the doom loop, out-migration. As taxes rise and services fall, fewer police, dirtier trains, the residents who can leave
do leave. They move to Florida, they move to Texas, they move to the suburbs. When they leave, they take their income tax revenue with them. The tax base shrinks even further. The city has to raise taxes again on the people who remain. It is a feedback loop from hell. The empty tower destroys the city that surrounds it. So, what is the end game? What does the future of the built environment look like?
We are moving toward a K-shaped civilization. Just like the K-shaped recovery in the economy, our physical cities are bifurcating. On the upper arm of the K, you have the fortress. These are the trophy assets, the one Vanderbilts, the Class A+ buildings in the flight to quality. These buildings will survive. They will be fortresses of wealth, guarded, maintained, and filled with the elite companies that can afford $200 a square foot rents. They will be islands of prosperity. But on the lower arm of the K, you have the ruins. This is the commodity office stock, the Class B and C buildings, the 1980s glass boxes. These assets are not coming back. The narrative that we can convert them all to apartments is a lie. I want to be very clear about this. The physical constraints, the floor plates, the plumbing, the lack of light make conversion financially impossible for most of these towers without massive subsidies. Costs for conversion run between $500 and $600 per square foot. In a market where selling prices are $120 a square foot, no developer will touch them. So they will sit there, ghost towers.
They will become vertical ruins in the center of our cities. Monuments to a credit cycle that went bust. They will rot. They will be stripped for copper. They will become hazards. And the cities around them will shrink. The tax base will contract. The social contract of the big city, high taxes in exchange for high services, will break. This is the reckoning. The banks are insolvent. The cities are bankrupt. The taxpayer is the bag holder. And the hope note is the only thing keeping the illusion alive. But here is the final twist. The twist that leads us to the true horror of this series. Everything we have discussed today, the $1.5 trillion maturity wall, the 98% price drops, the insolvent banks, this is all based on current interest rates. The entire extend and pretend strategy relies on one gamble, that interest rates will come down, that the Federal Reserve will cut rates back to zero, bail out the real estate market, and save the banks. That is the bet. But what if they can't? What if something happens in the global financial plumbing that forces interest rates up?
We have built a bomb. The commercial real estate market is a pile of dynamite. The 100 trillion debt is the gunpowder. But every bomb needs a trigger. It needs a spark. And that spark isn't coming from Washington. It isn't coming from a bank in New York. It is coming from Tokyo. In our next briefing, video 1.3, we are going to expose the silent assassin. We are going to uncover the yen carry trade. You are going to learn how a boring interest rate decision by the Bank of Japan has the power to crash the U.S. stock market, freeze the U.S. bond market, and blow up the extend and pretend fantasy overnight. We are going to show you why a butterfly flapping its wings in Kyoto causes a hurricane on Wall Street. The crash is visible, but the trigger is invisible. You have seen the empty tower. Now you need to see the mechanism that knocks it down. This is the architect. If you want to survive the wrecking ball, you need to be in the briefing room for the next loop. Click the like button, subscribe to the channel. Do not miss the signal. The math always wins.